Welcome in. My name is Derek Delaney, founder and president of PharmD Financial Planning. In the media, whether you're reading the paper or watching TV or scrolling through social media, you probably have noticed that there is a little bit of pressure being put on banks nationwide, and I could say globally as well, where the words banking crisis and banking failures have popped up quite dramatically over the last handful of weeks. And the reason for that is because, well, a lot of the reason for that as of now is the increase in interest rates. And those increased interest rates are putting a lot of pressure and negatively impacting the value of a lot of the bonds that these banks are holding on their balance sheet. So as interest rates continue to rise, the value of these bonds, which are assets on their balance sheet, continue to decline, which creates a lot of trouble. And that leads a lot of people to ask, why is it that when interest rates increase, bond prices drop? And in this video, I'm going to do my best to explain it in as simplified terms as I possibly can. So let's jump in. Let's first take a look at Bob. And let's just say Bob owns a bond and it pays him $1,000 a month and he wants to sell it for $6,000. And in the marketplace, Jane also owns a bond and it's paying her $1,200 a month and she also wants to sell it for $6,000. And Fred comes along and he goes, I'm in the market to buy a bond and these are my two options. Which do I want to pick? And the obvious answer is he's going to buy Jane's bond for the simple fact that he's going to pay the exact same price for that bond, but he will get $200 a month more in interest. And this gives you a good idea of what's going on in our economic marketplace right now. And that is because new bonds are being issued into the marketplace with higher interest rates. So they're paying more in interest. So people who buy those bonds are obviously getting more in return from a rate of return standpoint. So in order to incentivize people to buy bonds that are already existing in the marketplace that are paying lower interest rates, they need to do something. And that something is they need to lower the purchase price. So in this example now, Bob lowers his purchase price of the bond that he's selling by $50,000. Now Fred gets to decide, is it worth it to pay $50,000 less and buy Bob's bond that's only paying $1,000 a month, or pay an extra $50,000 more and buy Jane's bond that's paying the extra $200 a month in interest? And in this scenario, Fred decides he wants to buy Bob's bond. And again, this is exactly what is happening out in the marketplace right now, where these bonds that are newly issued bonds that are paying interest rates that are 3, 4, sometimes 5 times higher than bonds that are just like it, that were issued when interest rates were a lot smaller. Those older bonds need to dramatically lower their price in order to incentivize buyers to want to purchase them. Otherwise, there's no way they would ever get sold, and the market for those bonds would absolutely not exist because everybody in their right mind would pick a bond at the same sales price that's paying the higher interest rate. Now, think of that example and amplify it by tens of thousands. And now you can get an idea of what is happening on the balance sheet of these banks, where all of these bonds that they're holding are being dramatically impacted in a negative way from a price standpoint as interest rates go up, because the value of those bonds have to decrease. And as they decrease and these banks are forced to sell these bonds at a loss in order to meet withdrawal requests from their depositors, they are realizing those losses, and quickly the asset side of their balance sheet is sinking dramatically. So that is why when you look at the news and you hear about interest rates going up and how it's bad for our economy and it's bad for banks, the reason for that is because it's bad for the price of bonds. And a lot of these institutions and people all over America own bonds as part of their investment portfolios or something else. And as interest rates continue to rise, the price of those bonds are going to continue to decrease. And that is something we haven't seen before 2022 in decades. So it's going to take a lot of getting used to. And that is why there is a lot of talk about it happening now. And that's how it is negatively impacting banks in interest rate. And so next time you know this provides more clarity on and why people think